Topic focuses on fixed income markets for government issuers and explains how governments raise funds through debt securities. Government issuers include sovereign national governments, non-sovereign local governments, quasi-government entities, and supranational organizations. These entities issue debt to finance budget deficits, infrastructure projects, public services, and economic development initiatives. Government securities are among the most important instruments in global financial markets because they provide benchmarks for interest rates, monetary policy implementation, and portfolio risk management. Investors often consider sovereign bonds to be relatively low-risk investments because repayment is generally supported by the government's taxing authority and, in some cases, monetary control over currency issuance. Sovereign governments typically issue debt in domestic or foreign currencies depending on financing needs and investor demand. Domestic currency borrowing allows governments to access local investors and reduce exchange rate risk, particularly when debt obligations can be serviced using tax revenues denominated in the same currency. Governments with strong monetary credibility may also benefit from lower borrowing costs. Foreign currency borrowing can broaden the investor base and provide access to international capital markets, but it exposes issuers to currency risk because debt repayments depend on exchange rate movements. Sovereign debt management therefore involves balancing funding costs, investor diversification, exchange rate exposure, and long-term fiscal sustainability within changing global economic conditions. Non-sovereign government issuers include regional authorities, municipalities, and state-owned agencies that issue debt to finance local projects and public infrastructure. Examples include transportation systems, schools, hospitals, and utility networks. Repayment sources may come from general taxation powers or revenues generated by specific projects. Revenue bonds depend primarily on income produced by the financed asset, while general obligation bonds are backed by the issuer's taxing authority. Credit quality varies significantly among non-sovereign issuers based on economic conditions, fiscal discipline, and political stability. Investors therefore analyze financial strength, revenue stability, and legal protections carefully when evaluating non-sovereign government securities within diversified fixed-income portfolios. Quasi-government entities and supranational organizations also play major roles in government fixed-income markets. Quasi-government entities are organizations sponsored or partially supported by governments, such as development banks, housing agencies, or national transportation authorities. Supranational institutions, including the International Monetary Fund and World Bank, issue debt to finance global economic development and support member countries. These issuers often benefit from implicit or explicit government backing, resulting in relatively strong credit quality and attractive borrowing terms. Their securities are widely held by institutional investors seeking high-quality assets with moderate yields. These markets contribute to economic development by channeling capital toward infrastructure, trade support, and international financial stability initiatives. Government securities are issued across a broad range of maturities to satisfy varying financing and investment needs. Short-term instruments, such as treasury bills, are used primarily for liquidity management and cash flow financing. Medium-term notes and long-term bonds finance ongoing expenditures and infrastructure investments over extended periods. Governments often maintain regular issuance programs to support liquidity and establish benchmark yield curves across maturities. These benchmark securities provide critical reference rates used to price corporate bonds, mortgages, and other financial instruments. Investors rely on government yield curves to evaluate interest rate expectations, economic conditions, and relative value opportunities across global fixed-income markets. The issuance process for government securities differs from corporate bond issuance in several important ways. Sovereign governments frequently issue debt through competitive auctions conducted by central banks or treasury departments. Primary dealers participate in these auctions and distribute securities to investors. Government securities generally trade in highly liquid secondary markets with substantial participation from institutional investors, banks, and central banks. Compared with corporate bond markets, government bond markets typically exhibit greater transparency, lower transaction costs, and narrower bid-ask spreads. High liquidity enhances market efficiency and allows government securities to serve as key instruments for monetary policy operations, collateralized lending, and global reserve management activities. Credit risk in government fixed-income markets depends on fiscal strength, economic growth, political stability, and debt sustainability. Sovereign governments with strong economies, diversified revenue bases, and credible institutions generally enjoy lower borrowing costs because investors perceive reduced default risk. Conversely, governments experiencing fiscal deficits, political instability, or economic weakness may face higher yields and limited market access. Credit rating agencies assess sovereign creditworthiness based on macroeconomic indicators, fiscal policy, monetary flexibility, and external balances. Changes in sovereign credit ratings can significantly affect borrowing costs, currency values, and investor confidence. Therefore, government credit analysis requires both quantitative financial assessment and evaluation of broader economic and political conditions. Topic ultimately highlights the essential role government fixed income markets play in global financial systems and economic development. Government securities provide financing for public investment while offering investors relatively secure and liquid investment opportunities. Benchmark yield curves derived from government bonds influence pricing across virtually all fixed income markets. The interaction among sovereign issuers, central banks, institutional investors, and financial intermediaries shapes global interest rates, liquidity conditions, and monetary policy transmission.